Thank you very much. And we're very lucky to be beginning this session on the mega deal on a day when people are feeling somewhat enthusiastic, as you just said. And I'd like to start with you, Paul. Back in May, I think, seems like such a long time ago, you said that given low level of interest rates, the enormous amount of cash that companies have at their disposal, we were likely to see the 2007 record for global deal volume surpassed by 2013, $4.5 trillion. I think that's the number. Are we going to get there?
Well, the timeline may be extended, but I think, frankly, it's going to really depend on the economy. M&A follows the economy almost exclusively with a bit of a lag. So asking about the big deals and how big the market can be is a little bit like asking for more ice cubes on the Titanic. It's just misplaced in terms of where we expect to see the market. It will narrow down because of the cash levels and the low interest rates. To those who are unconstrained and the high-grade issuers will be able to press their advantage. And we will see good M&A activity in that group unless the market falls off entirely in Europe. And if Europe doesn't, again, get its act together, then all bets are off.
But I'm detecting hesitation now from you compared to where you were just a few months ago. Is that fair to say?
Well, sure. The market, and it really depends on where you're sitting. And if you're in Europe, you have a very different perspective. If you're in the U.S. Versus in Asia. If you're in Europe, I flew back last night, sat with a number of senior executives at companies who all shared a very depressing vision of the world, and not in their own companies, although they are seeing a slowdown. What they're really concerned about is the sort of the guillotine of uncertainty that's overhanging them now. And it's a real lack of confidence in the political system to come to terms with the issues facing them in a timely manner. And it really is the timeline. In the U.S., it's much more uncertainty, want a more stable environment with some clarity. But again, most major companies are out of position as it relates to emerging markets. Most are sitting on huge amounts of cash, $250 billion just in the top 15 tech companies alone, $2.5 trillion globally. Zero interest rates, burning a hole in the balance sheets, and the activists are being very vocal in terms of what happens if they don't deploy that cash or give it back. And so there is a strong impetus for getting deals done. But deal makers are intelligent. It's binary. It's going to follow the economy. And so if there's a fiscal crisis or a financial crisis, that will clearly impact the market.
Maybe there's a reality check here, Wilbur. You recently had an agreement, I think it was about a $900 million deal to buy 30 tankers. And I just wondered, is that deal going to go through? Is it on schedule?
Well, it closed last night at midnight, so that's the first answer.
Okay, so that's a good sign then.
But it's very rare that I'm called a reality check, so I'm very flattered that you use that terminology.
And is it changed? Is it the same as you outlined?
Oh yeah, the deal is the same, and I think you're going to see more transactions in shipping. Shipping is a very capital-intensive industry, a global industry, but highly fragmented. We'll have altogether 38 tankers. Between crude tankers and petroleum product tankers, that's one of the larger fleets that there is. And yet there are thousands of vessels on the water. And that's one of the problems of the industry. It's too fragmented. So what made the opportunity for us, a few years back, charter rates went to the moon, around about 2007. So everybody over-ordered vessels. Those are now coming through. And there's oversupply. There are people can't meet their purchase commitments, things like that. And that's obviously the reason we went into the business.
Sounds pretty bullish to me. What am I missing?
Well, what we did to protect ourselves, the ships we bought, for the most part, have long-term charters averaging over 4 years with creditworthy users that were entered into during the peak period. So we think we'll have enough revenue stream to get us through this bad period, and then we'll put them into the spot market on the other side when things get better.
And so from your perspective, what would you say the M&A pipeline at this point looks like, well, especially for the deals of $10 billion or more?
Well, we're not so much into the 10 billion or more deals. That tends to be closer to our exit price than our entry price. So I hope on the other side of the cycle, the big deals do come back. But I think Paul is quite right. I've noticed over the years that for corporate buyers, when their stocks are up, they're much more likely to do a deal than when their stocks are down, even if they're not using shares. It's just that people feel better when their stocks are up. We try to be a little bit contra-cyclical, and we're at the opposite end of the barrel, trying to go into things that are depressed, not things that are inflated.
And Paul, would you say on that point that there are a lot of would-be sellers who are refusing to lower their prices as shares declined?
Well, as the market, again, was probably too optimistic over the past 2 years and had a very nice run up, people felt, let's keep riding this, and then if I choose to sell, we'll take a premium on top of that. Now that they've come back off, I think targets, I won't call them sellers yet, but I think targets are going to season and see at those levels, maybe they'd like to get back at that 52-week high if a deal can be done. And what I'm still waiting for is the stock-for-stock transactions, where you can really ride some upside, share in the synergies, and that you're not so much a seller as you are a participant in the upside, plus you're getting a premium. But we're at 15% of all deals right now, or stock deals, which is the lowest going back to 2000. You haven't seen anything of that level. And 65% of deals are all cash. And you add another 10% for the cash and stock. Make sure it's 75% of all consideration is cash. So you have to be a seller willing to cash out if you're going to take a deal today.
So does that mean that your characterization is valuations today are attractive, or are they unattractive? Where would you?
Again, if you look at forward Ps over 10 and 20 years, you would say that they're attractive. But then you have to confidence in what the E is to make sure that you're not overpaying. But it feels like, particularly given interest rate levels, that you can deploy that cash. Again, you're earning 0 on 7% of your corporate assets globally, which is where companies are today. You need to deploy that cash.
So do you think this means we're going to return to these big club deals? Are we in the environment that lets us do that?
In the private equity world? Well, private equity is about 15% of all deals this year. But dropped off 50% in the past month and quite a bit this quarter. There is no high yield market for meaningful private equity deals. And so that part of the business alone, you're going to see fall off for probably the rest of the year until the market opens back up.
And breakups, we're seeing a lot of discussion of breakups. Are they being driven by what factors at this point?
Well, there are over 100 spins and splits this year alone. It's multiple volumes of where we were of the prior 2 years. Clearly, companies are shrinking to grow, if you will. And I think I call it the 3Ds. You're going to deploy your capital, you're going to divest businesses, and then you're going to deleverage. And it's going to happen mostly in that order. And so deploying the cash and then breaking up into bits and pieces. You saw that with Pfizer. You're seeing it with Kraft. They're using their large size and cash flow and cash to make a big acquisition, but then they're reshaping themselves and reshaping their balance sheet to be positioned long term. The market does not reward slow growth. It rewards growth or high dividends, but not something that's just caught between.
And is there any combination of firms you see looking at, for example, HP or Yahoo? I wouldn't say maybe private equity, but is there a possibility that people get together jointly?
There's always a possibility.
Is that something you're pursuing?
I think Nouriel needs a question.
We're going to get to him in a second. But I wanted to ask, before we get to him,
Yep.
What do you say about that? Companies getting together and buying, say, HP or Yahoo?
In getting together in this tax regime in the U.S. market, it's difficult to do that. It's something that could be done much more easily overseas, where you can tend to break things up without a tax consequence. But in the U.S., it's hard to do.
Okay.
Not impossible.
These gentlemen have been modestly bullish. You are, I would say, decidedly bearish. If you did deals, would you do them now or do you wait? And if you wait, when do you wait? Now or the hereafter?
Well, I'm a macroeconomist, and I believe as economists in comparative advantage, and you have two experts about deals and M&A. So I'll think about how maybe the macro can affect the deals. The way I see the global economy, I think we're entering in a recession again in most advanced economies. I think we're already into one in the US based on the hard and soft data. Same with most of the Eurozone, same with the United Kingdom. I think at this point, the issue is not whether it's going to be a recession or a double dip, but whether it's going to be relatively mild or whether it's going to be a severe recession and a global financial crisis like 08, 09. And I think the answer to that question depends on what's going to happen in the Eurozone and whether they can get their act together and resolve the problems or not. And it's a very long story, but I would say there's more than a 50% chance that the Europeans, because of political, institutional, and other constraints, are not going to be able to do it, and you could have a disorderly situation in Greece, in Italy, in Spain, and severe consequences. You know, this could be worse than Lehman if things happen that way. So what does that imply? You know, in a typical US recession, from peak to trough, S&P 500 falls by about 28% nominal, 22% real. During last recession, the fall from peak to trough was more like 60% plus. So we're only maybe 15% down from the peak right now. So even if it was a mild recession, you have to go all the way to close to 30. There's a chance 50% is going to be worse than that, in which case it could be much worse than that. So the M&A deals follow the real economy. Of course, corporations are flush with cash. They're not doing capex. They're not doing job hiring. For a while, they were doing financial transaction, M&A, share buybacks, cleaning up their balance sheets and pension plans. But if the economy is going to be that bad, it's not going to be good for valuations. Therefore, that's going to be a constraint. And there is a huge amount of uncertainty. There is economic uncertainty, financial uncertainty, fiscal uncertainty, political uncertainty, geopolitical uncertainty, policy uncertainty, regulatory, and you name it. And whenever, one of the basic principle of economics is when there is uncertainty and risk, there is an option value of waiting. That's why firms are not spending. If you don't know if the economy is going to be better or worse, better wait and see. Wait another 6 months until you do another building a factory, hiring workers, more capex. And we're seeing the effects of it and becomes self-fulfilling. And I think also in financial transaction, there is an option value waiting until, of course, prices have fallen enough that there is fire sales, and then you go and there is a lot of distressed activity and all the rest. So I think that, that also has a negative effect on M&A activity because you could buy too high right now, and therefore there is an option value of waiting. So I think that eventually there may be some great deals to be done and lots of sophisticated people who can do them in good times and bad times, but overall the macro and the financial uncertainty means option value of waiting for real economic actions as well as some of the financial actions as well.
So if half of what you just said is accurate, then we're already very frightened. Wilbur, what would you say is the right strategy?
Well, we gave up a long time ago trying to pick the exact bottom, because the only way you know it's the exact bottom is after you're on the way back up. So what we try to figure out is, can we get through a protracted bad period with the capital structure we're putting? And then is there an opportunity to rationalize that entity and perhaps the whole industry? So we have a little different time denomination to our point of view on things. But I do agree with Nouriel very much about Europe. I think the problem with having that kind of a structure, or more accurately, lack of a structure, is there's no way to make a decision. Imagine if the United States were run by a combination of 17 Newt Gingriches and 17 extreme left-wing people, and they all had to agree on everything. We're practically there anyway, but in Europe, they still haven't approved the bailout package that was supposedly agreed back in July. I think only 6 of the 17 have voted on it to this point. So now we're lurching into a period where they need a much bigger package, and I know Nouriel does. How they're ever going to get their act together to do that quickly escapes me. So I think we're getting to an inflection point in Europe.
Is it possible that we Americans, as I think European policymakers are like to remind us, are still having a difficult time understanding Europeans, and that perhaps our pessimism is misplaced?
Well, the Europeans were too optimistic throughout this whole thing. They put a stress test, so-called series of stress tests on the banks. 2 years ago, they said the Irish banks had a €3 billion hole. So far, it's been 35 billion euros. That's a big miss. And I think their stress tests were not really designed to be stress. They were designed to relieve stress on the part of the public, and they failed in both regards.
And yet you are, if I'm not mistaken, of all the countries you've looked at that are supposedly troubled, Ireland is on your
Oh,
list.
yeah. Well, we announced a transaction to buy Bank of Ireland. It's the biggest bank there, and it's actually quite a large institution. It's about the same size as Bank of New York Mellon, about 165 billion in assets. The reason we like Ireland is, unlike what I call the Club Med countries, the entire economy doesn't need reforming. It had been the miracle of Europe until the banks went nuts and made bad loans in Ireland. Then when they ran out of bad loans to make there, they went to Spain, they went to South Florida, they went wherever they could find them. So it's a one-time peculiar problem. But what's intact is what made Ireland strong to begin with. Lowest corporate tax rate in Europe, favorable trade balance with the rest of Europe and the rest of the world, young, well-educated workforce, good IT and transportation infrastructure, and the only English-speaking language on the euro. Those are powerful fundamental advantages. And government, unlike the others, acted swiftly in the crisis, even though they had something like 13% unemployment, and even though unimaginably pub sales were down 11%. That's my leading indicator for Ireland is pub sales. Even though that was the economy, they cut the entire cost of civil service 13% in one shot, cut out government-funded CapEx, and cut back on social services. Now, it brought a change in political party, but the new party is adhering to the same regime. And lo and behold, in the last quarter, Ireland actually had positive GDP growth. Not a lot, but considering what they just went through, remarkable. So I believe Ireland will clearly be the first country to recover from whatever this protracted period is.
Yeah, and as you just said, Irish bonds are relative outperformers in the bond market the past several months. I was going to come back to the word that all of you have shared here, uncertainty. Is this a synonym for fear? And is it possible that the only thing we have to fear is fear itself? And that's this.
No.
Why is that?
Well, there really are problems. You do have the sovereign debt crisis. You do have the European bank problems. European banks are very different from American banks in two regards, three. One, they never really took the write-offs from the last problem period. Two, they have fundamentally less capital relative to their size than the Americans. And third, and most important, their deposit structure is smaller than their loans. Most American banks have quite a bit more deposits than loans. Mm-hmm. European banks are the reverse. That means they're extremely dependent on the wholesale funding markets, in plain English, hot money. That's what makes them vulnerable. And as the hot money has been shrinking the duration of its lending to the banks and pulling out of them, that's what's causing the liquidity crunch that the ECB is trying to fill. So those are real problems. The structure of Europe, where the central bank has control of monetary policy, but nobody has control of fiscal policy, how do you manage something like that? Those are severe structural problems that are really the things I'm worried about, much more than whether we're in a short-term recession or not, because those are fundamental problems.
So what happened, Paul, to the mega deal? Is it gone? Is it built for a bull market?
Well, again, the mega deal is really sort of 25 billion and over. The $100 billion deal, which was the title, there have only been 3 since 1995. So it's a pretty small universe and only 43 companies above 100 billion. So it'd be a hard thing to do. Again, for those unconstrained companies, the big companies, they've got an ability to do it. The high-grade capital markets are open. And in fact, since 2008, rates have come down from 8.5% for very large deals to less than 4.5%. That's a very meaningful number when you apply it to the size that we're talking about. But if you look at the top 15 companies globally, for Chinese, their average growth rate is 65%. The 9 American companies, their average growth rate is 1%. So there's a very big difference, and again, you're out of position if you're not permanently in the emerging markets, and not just for manufacturing, but really being there to take advantage of the demographic shift, the growth, the unlevered consumer, the increase in the standard of living. That's where people need to move, and they're spending an awful lot of time. And so those are not going to be the biggest deals because they're not the biggest companies, but that's where it's going to be a longer road. And people are, again, they see much more growth and much more interest there. Europe, I will say, though, to your point earlier, they're more depressed than we are. You mentioned the Americans are too depressed. We're far more optimistic. The Europeans believe, and the CEOs, you see this when you talk to them, that a half-built bridge has been constructed and a half-built car is driving over it. And they don't have an ability to get off. And that's the concern they have, is where's the political will, but they do not want to see the euro unwind, and they don't believe it can, given all that they have invested in it so far. And I think that's the real question, and it's, as Wilbur said, we're clearly coming to an inflection point.
Well, but the euro right now is still trading well above where it started. And
had conversations yesterday, though, with executives who were thinking about drawing down their bank lines. I mean, that's the mentality, and they said, look, we know that's the worst place to go, but how could we not think about that, given what we're seeing as a lack of political will, and you take the tea leaves, they're not good.
Dr. Roubini, help us understand this. Given as dire as you say it is, why is the euro relatively buoyant at 134 to the dollar? I would have thought at this point that there might be something much more drastic.
Well, the way I define the Forex market is a beauty contest when the issue is not who is the prettiest or more handsome, but who is the least ugly. So, depending on the month or the quarter, last year when Greece was on the verge of collapsing, euro went from 150 to below 120. Then they patched the things for Greece and the Eurozone, and they were the risk of a double dip, and then the euro became less ugly, went back to 140, 150, and then the Fed did the QE, and now there is trouble in Ireland, in Greece, and Portugal, and again, the euro is up and down. But the reality is just, with the tallest midget in the room, or with the least dirty shirt in a very dirty laundry bag. So fundamentals of macro, fiscal, financial, economic are terrible. The dollar should be weaker so we can grow our exports. The euro should be weaker so the Eurozone periphery is safe. The pound should be weaker because the UK economy is contracting. Japan needs a weaker yen because they have to grow their exports and they have a double dip recession. Even if Swiss decided to peg to the euro because the Swiss franc was becoming too strong, the Chinese want a weaker currency to grow their exports and maintain export-like growth, and everybody's shadowing China because China is shadowing the US dollar. So we are in a world in which everybody wants a weaker currency, but if the currency is weaker, the other has to be stronger, and if my trade balance is better, your trade balance has to be worse, because the sum of trade balances in the world is equal to 0. We don't trade with the moon, so it's a zero-sum game in currencies, it's a zero-sum game in trade balances, and therefore, the euro should be at parity with the dollar in order to save the periphery of the Eurozone. Otherwise, they're going to destroy themselves, but with the parity at the dollar, there's not going to be any recovery in the United States. So it's a wash among currencies. It's just, that's what's happening.
Also, foreign exchange is notoriously difficult to forecast. Even though it's a $4 trillion a day market, it's really quite erratic on a short-term basis because there are too many intervening variables in it.
Dr. Roubini, let's just think about where we were in the 30s, where you could argue it was much worse than it is today. And you could also argue, I think, Paul, you would back this up. That was probably one of the best times to do deals in the depths of the Depression. Not today?
Well, if you go deep down, of course, valuations are so low that then there is a whole business of fire sales and distressed debt and distressed assets, and call it creative distraction, call it whatever you want. But of course, there'll be lots of room for deals, and certainly globally, you could have more consolidation in the right industry and should occur. But I think one of the other things to keep in mind is, in addition to trade protection, is when there is economic and financial pressure, there's also asset or financial protection is under excuse of national security. We saw the Calcino case, we saw the Dubai ports, but there are tons of the same things happening throughout the world with a backlash against cross-border foreign direct investment because a firm is going to come, take over your jewels, they're going to fire workers and whatever not. And it's happening in Asia. See what's happening in Temasek as they expand globally. It's happening in Latin America. It's happening within the Eurozone. I mean, within the Eurozone, they blocked acquisition of Danone. It's a yogurt company based on what? National security? What was the strategic importance of a yogurt or milk maker? But in France, they're resisting it. Or think about the cross-border in the banks. The banks have been used in Europe as a political tool for achieving national political targets, like buying bonds of the national governments, directed and connected lending. And there has not been as much cross-border mergers and acquisitions. And in periods of stress, actually, the political resistance to do more of it becomes exacerbated. So we should worry about financial and asset protections as much as we worry about, or the role of sovereign wealth funds. They say they're government-owned, so they're going to take over, and they don't have transparency. So those are also constraints to cross-border stuff.
Let's try to give our guests some perspective on where we're going here. Next 12 months, more or fewer deals, greater volume, Paul?
Well, the deals are already fewer than last year at this point. It may not supersede last year. I think it really is binary. It's going to depend on where the economy goes. We're more positive in terms of it only being a 20% or so chance that there isn't resolution in Europe, and I know Nouriel is more sanguine.
More or fewer?
There will be fewer, subject to there being a better economic environment.
Wilbur?
I think there'll be fewer and they'll be smaller simply because the prices will be lower.
And a year from now?
Well, I don't know. I think that the economic outlook is going to become difficult for the next 12 months, severely more difficult. And we'll see whether then policymakers can get their act together. But we're running out also of policy bullets. Everybody's doing fiscal austerity. Monetary easing is becoming less effective and more impotent. Backstopping the banks by sovereign debt insolvent is more difficult. Not everybody can have a weaker currency. So I think 2 or 3 years ago, every time there's an economic and financial downturn, we could take another rabbit out of the hat with all the policy bullets. Now we're running out of policy bullets. So if there's going to be an economic and financial downturn, the risk is that actually we don't have any more of the policy bullets to get us out of this. I think that's another additional source of risk we have to face.
And I'm afraid for this panel, we're out of rabbits. So thank you very much.
Out of time here, but it's been a pleasure. Thank you very much.